Okay, thank you everybody for coming. Next up, on behalf of the Faculty of Commerce and Accountancy, Chulalongkorn University, it is my great pleasure to invite one of the world's leading scholars to express his views on high-frequency trading. But first, I would like to take this opportunity to introduce our special guest speaker today, Professor Hendrik Bessembinder. Professor Bessembinder is an A. Blaine Huntsman Chair Presidential Professor of Finance at David Echo School of Business at the University of Utah. His research interests focus on financial markets, including market design and trading cost, stock market, foreign exchange market, derivative security market, energy market, risk management, and international financial market. Professor Bessembinder publishes extensively in top-tier journals, including the Journal of Finance, Journal of Financial and Quantitative Analysis, Journal of Financial Economics, and Reviews of Financial Studies. He is also the managing editor of the Journal of Financial and Quantitative Analysis. Today, we are very honored to have him as our special guest speaker on the topic of high-frequency trading. Ladies and gentlemen, please welcome Professor Hank Bessembinder.
Well, thanks very much for the kind introduction, and thanks for inviting me here today to say a few words. It's an honor, and I'm happy to be here. I am indeed an academic who studies the financial markets. I'm not a trader, at least not on a regular day-to-day basis, but someone who's really a student of the markets and has made my living studying the markets and reviewing research by others regarding the markets. So I'd like to offer my perspectives on this controversial, timely topic, high-frequency trading, but keep in mind it is from my viewpoint as a student of the markets. So high-frequency trading, for starters, is a little bit difficult to define exactly. It seems that not everybody uses the term in exactly the same way. But broadly speaking, when people talk about high-frequency trading, they seem to have a few characteristics in mind. First of all, traders who are relying on computer programs to generate, enter, and cancel orders, who capitalize on speed. High-frequency traders are often make extra investments to co-locate their trading computers in close physical proximity to the stock exchange's matching computers. And I guess given the audience we have here, many of you already knew that, but just stop and reflect on it for a second. Electronic signals move more or less at the speed of light. Nevertheless, the firms are willing to invest large amounts to be a little bit closer to the exchanges. So they're attempting to capitalize on the very finest price increments in terms of the speed of reaction to information and entering and canceling orders. High-frequency traders, at least as the term is most often used, are trading as principals. They're trading for themselves. So that actually distinguishes high-frequency trading from the broader category of algorithmic trading. And in particular, it distinguishes it from the algorithmic trades that are used on behalf of investors to execute the investors' orders. As a matter of fact, for those of you that have an interest in algorithmic trading more generally and who are involved in algorithmic trading where the algorithm is executing customers' orders, it's important to be aware of and have some appreciation for what the high-frequency traders are doing. And last characteristic, high-frequency traders apparently, or most often, will try to avoid carrying inventory overnight. They'll try to go home flat when possible. So that's roughly speaking a definition of high-frequency trading. High-frequency trading gets a lot of bad press. Now I'm going to focus mainly on the publications that I read most often, which are the New York Times and the Wall Street Journal. But I'm sure that the bad press is not unique to the United States. But I'm going to give a few examples from the U.S. press. This is a rather striking one. This is from an article that ran in the New York Times in 2009. Stock traders find speed pays in milliseconds. So I just want to pick up a few quotations. Powerful computers, some housed right next to the machines that drive the marketplaces, enable high-frequency traders to transmit millions of orders at lightning speed, and their detractors contend, reap billions at everyone else's expense. No, it's not just high-frequency trading, but you'll often run into the reasoning that if one party made money, must be because they took it from someone else. That's just not necessarily true. You can make money by providing socially valuable services. So, this sort of inflammatory phrasing, that they do it at everyone else's expense, is just that. It's inflammatory phrasing. And where I'm going to go with this is provide a few indications of the sort of press coverage and then try to turn to the systematic evidence that's available about what high-frequency traders do. So reap billions at everyone else's expense. Powerful algorithms execute millions of orders a second, scan dozens of public and private marketplaces simultaneously. I think those parts are probably true. They can spot trends before other investors can blink, changing orders and strategies within milliseconds. Probably true. High-frequency traders often confound other investors by issuing and then canceling orders almost simultaneously. Their computers can essentially bully slower investors into giving up profits. That's a pretty strong statement. You're bullying other investors into giving up profits. There's not a lot of actual hard evidence to back up these sort of statements. And finally, from... This one goes off. Okay. So it's become a technological arms race, and what separates winners from losers is how fast they can move. So if you're not a high-frequency trader, give up. It's an arms race. If you can't move as fast as they can, if you're not co-located next to the exchange. All right, so that's pretty seriously bad press. And the New York Times is considered, well, they're a little bit on the political spectrum, a little bit left, but they're a very influential publication in the U.S. More bad press. This was triggered by an event that some of you might be aware of from just this last August. So Knight Securities, a trading firm, it's been around for a long time. Knight Securities had a little problem. They installed new software overnight, apparently didn't test the software as much as they might have later wished they had. But when the market opened, their software issued a large quantity of orders that they didn't intend to send out. A couple of days later, it came out in the New York Times that as the torrent of faulty trades spewed out, nobody could find the off switch. Now, that's admittedly rather embarrassing, and it does go to one of the potentially legitimate concerns about high-frequency trading and computer-generated trading in general, is what if something operates in a way other than what was intended? And I'm sure there's lots of people here who have written computer code. I'm not a trader, but I've written computer code. I can verify sometimes the code doesn't do what you thought it was going to do. Which is, of course, why you should be testing before you go real time. But in this case, it issued a torrent of unintended trades, and embarrassingly, they had trouble turning the programs off for a half hour. But that created a lot more bad press. The chairwoman of the United States Securities and Exchange Commission called the episode unacceptable. I think Knight views it as unacceptable as well, since Knight lost $440 million trading that day. The trading itself, though, is zero-sum. So if Knight lost $440 million, somebody else made $440 million. That part doesn't get reported. It's as though the loss just evaporated. High-frequency trading definitely poses challenges for regulators, and I'm going to talk about some of the regulatory issues as we go. But part of the challenge is just sheerly in the data processing. If it's your goal to monitor the markets in real time, and there's a lot of high-frequency trading going on, it's a tremendous challenge to process and visualize the amount of data that's required. So something that I thought was an interesting point of comparison, this is another New York Times article, to regulate rapid traders, SEC, the United States Securities and Exchange Commission, turns to one of them. And you can see, hopefully, the phrasing there, but interestingly enough, the regulators are turning to a high-frequency trading firm to design their computer algorithms for monitoring high-frequency trading firms. Apparently, the only place that you can get sufficient expertise in handling the data and writing the programs is with the high-frequency trading firms themselves. All right, so more broadly, what sort of complaints do we see about high-frequency trading? I just tried to categorize it a little bit. One complaint about high-frequency traders is they disappear from the market when they're most needed. Kind of like there's an old complaint about banks. Banks are the people who are always willing to loan you money except when you really need it. So it's kind of a similar parallel complaint. High-frequency traders, they're always there except for when you really need them. The concern and the Knight Capital event added legitimacy to the concern that algorithms could do something other than what they were intended to do and destabilize the markets. This is something I want to come back to a couple of times during the course of our hour. There are concerns that high-frequency firms trade ahead of other people's orders. And that comes under various labels. So trading ahead, front-running, some people have called it predatory trading. The concern is essentially that the high-frequency trader will forecast when somebody else is going to do a substantial order, or maybe they just use pattern recognition software to detect when somebody else is executing a large order. But in either case, they detect the large order, they trade in front of it, or simultaneous with it, has the effect of pushing the price farther than it needed to be pushed, and then they trade out of the position afterwards. So this concern is voiced periodically. There are periodic claims that high-frequency traders manipulate the markets. Now, the term manipulate is another one of those terms that doesn't have a very precise definition, or at least not everybody uses it to mean exactly the same thing. And I don't know the exact situation here, but I know in the US there's considerable uncertainty as to how to exactly define manipulation from a legal perspective. From an economic perspective, we can say generally it's taking strategies to create prices that reflect something other than the normal forces of supply and demand. And it's periodically asserted that high-frequency traders manipulate the markets. Another complaint you hear about high-frequency traders is that they create excessive amounts of message traffic on the computer networks. A phrase that's sometimes used is quote stuffing. And I'll point to at least one paper that has some evidence on that. It is definitely the case that in markets where high-frequency traders are active, the order-to-trade ratio tends to be high. The number of orders submitted relative to the number of trades completed tends to be high when the high-frequency traders are active. Fairness. It seems we're all, as humans, born with a taste for fairness. Even with little kids, you want to get them upset, do something they perceive as unfair. The problem is, though, that while we all agree that fairness is good, we can't always seem to agree on what's fair. But fairness is definitely an issue that's in the background or maybe in the foreground in discussions of high-frequency trading. So just as a point of comparison, The Dodd-Frank bill that was adopted in the U.S. 2 or 3 years ago in the wake of the financial crisis, the Dodd-Frank bill was not about high-frequency trading in particular. It was a broad response to the financial crisis. But that bill used the words fair, unfair, and fairness 130 times. So I just take that as an indication of the extent to which legislators and more broadly the public cares about the fairness of the financial markets. And definitely perceptions of fairness show up in the discussion of high-frequency traders. So if we had more time, we could survey the audience here. Yes, we don't have time. We won't survey the audience, but you can each draw your own opinion. I have my opinions, but I'm not necessarily here to tell you my opinions about fairness. Let me just pose some questions to think about. Are these things fair or unfair? So a high-frequency trading firm makes an investment in technology that allows it to collect and react more quickly to market information, while some other parties choose not to make the same investment. A traditional market-making firm that's been in the business of providing liquidity to the markets, maybe for years, maybe for decades. A traditional market-making firm that has been earning a nice living, providing liquidity to the markets, finds that it can't compete with the high-frequency traders. A high-frequency firm hires some Ph.D. computer scientists. They write pattern recognition software, programs to detect, on the basis of publicly available information, to detect when somebody else is working a large order, and then they trade in front of it. It's publicly available information, but they get in front of the order that's being worked. The high-frequency firm enters a large volume of limit orders as part of its market-making operations, modifies those limit orders frequently, that is, cancels and reissues limit orders frequently as its inventory and market conditions change. High-frequency firm enters and cancels a large number of quotes in order to slow down message traffic. I think you see the difference between those last two, but they might be hard to distinguish in the data. Anyway, I just throw those out as some examples of the sort of things that a society and regulators are going to have to think about in terms of thinking about whether high-frequency trading is fair or not. Just one more quotation from the press. So this was an article. Notice most of these articles I picked up from the last month or two. This is definitely a high-profile set of issues. So from an article in the Wall Street Journal just in September, for super-fast stock traders, a way to jump in line. So the first part is just a statement that perceptions of whether the exchanges are treating high-frequency traders the same way as they're treating the rest of the investors are really crucial to people's perceptions as to whether this is fair or not. Recently, the New York Stock Exchange settled charges that they had been providing data faster to certain traders than to a public database. This last point is again goes to the question of what's fair and unfair. Exchange officials don't deny that they make available certain things that can be advantageous to a high-frequency trader, but they essentially say, look, this is available to anybody. It's not our fault that not everybody can take advantage of it, because they haven't co-located, for example. The last part of this article, and we don't really have time to get into the details here, but there's a particular market in the U.S., and I don't know if everybody is fully familiar with the degree of fragmentation of trading that we have in the U.S. now. Several years ago, two markets, the New York Stock Exchange and NASDAQ, did the lion's share of trading. But that's greatly changed in the computerized trading environment, and new markets like Direct Edge and BATS sprang up and almost overnight captured 10-15% shares of the trading activity. But this particular market, Direct Edge, created a particular type of order that they called the hide not slide order. And you can look up the article if you want to get the details. But the order was essentially designed to let high-frequency traders hide their orders in a way that the general public could not. And that sort of thing is definitely going to fuel perceptions of the game is rigged. The game's not fair for regular investors. On the other hand, as we go through this stream of criticisms of high-frequency trading, it doesn't hurt to ask ourselves about the incentives of the people who are complaining loudest. So I call this a case study of a critic. So this firm, Themis Trading, issues press releases every now and then, and they caught the attention of the New York Times writer. And we got an article just back in September searching for a speed limit in high-frequency trading. So you can look up the article and get the rest of the details, but I'd characterize it this way, as the New York Times reporter basically said, okay, some Wall Street insiders are going to come forward with the scoop on high-frequency trading and how it's not good. So it starts to list a set of complaints about high-frequency trading. The complaints are coming from these two individuals, Arnouk and Saluzzi at Themis Trading. So the complaints that are listed in the article, I'll talk more about the flash crash in the US. Mini flash crashes. What do they mean by mini flash crashes? Cases where the price of an individual stock will plummet before it recovers. Stock by stock. All right, so there's an assertion that many flash crashes have occurred with surprising regularity in a wide variety of individual stocks. No actual evidence, but the assertion that this happens. Again, the assertion that high-frequency firms will disappear from the market just when we need them most. Arnouk and Saluzzi, they also contend that ordinary investors are paying more for their trades, not less, because computerized traders pick up information about stock orders and push up prices. It's the front-running argument that they get in front of the orders, buy ahead of your order. All right, so a list of complaints about high-frequency trading. It's only near the end of the article that there's a couple of what I think are telling quotations. Both men say they wish Wall Street could go back to a calmer, simpler time. All the way back, say, to 2004, before we had all these pesky high-frequency trading firms. And then what I think is the most telling comment of the entire article, Mr. Saluzzi acknowledges that computerized trading has hurt firms like Themis, which execute trades on behalf of clients. Many former Themis clients now trade via algorithms with no human involvement. In other words, it comes out at the end that they're one of the firms who is not able to compete with algorithmic traders. The high-frequency traders do seem to be profitable. We probably could have inferred that from the fact that there's a lot of them and that they pour a lot of money into hiring programmers and putting computers close to the exchanges. A particular estimate here, this is from the Tab Group. Tab Group is a company, consulting firm that monitors the markets and issues reports periodically. But according to the Tab Group, the industry, the high-frequency trading industry, earned about $13 billion over the preceding 2 years. All right, so I'm an academic. I'm trained as an economist. When I see that a particular activity is profitable, I ask myself, well, where could these profits be coming from? So, trading always has a random element to it. Anybody can be lucky on a given day or unlucky on a given day. But if an activity is making money consistently, there should be a reason, an explanation for why it's consistently profitable. So I just tried to list what in my mind, and based on my reading of the literature, what are the plausible reasons that high-frequency trading could be consistently profitable. So first thing that comes to mind for me is that they're providing a socially valuable service that society is willing to pay for in the competitive equilibrium, supply-demand equilibrium, and that service in particular, provision of liquidity to the markets. Liquidity is socially valuable. It does cost money to provide it. And being in the business of providing a socially valuable good or service, assuming you're sufficiently good at it to be competitive, you should be able to make money at it. So clearly one possible reason is liquidity provision. Second possibility, broadly speaking, arbitrage. Arbitrage can come in several different forms, but it's basically looking for misvalued securities and trading on it. So-called pairs trading is a form of arbitrage. So-called stat arb is a form of arbitrage. But generally speaking, looking for misvalued securities and taking positions. And it's plausible that high-frequency firms, they're plugged into every database they can possibly be plugged into. It's plausible that they're, in fact, able to detect and trade on mispricing more quickly than others. The third one we already touched on. It is indeed plausible that they're making money through order anticipation strategies, through detecting others' orders, getting in front of the others' orders. So as I mentioned, sometimes called front running, sometimes called predatory trading, sometimes called order anticipation strategies. And then it's at least possible that market manipulation is involved. And I'll just leave a fifth category, other, in case I've missed anything. But there's at least these four possibilities for how they make money. I want to offer just a bit of perspective, though, on these potential sources of profit. Liquidity provision and arbitrage are good, from my viewpoint at least as an economist who studies the markets. So if we back away a little bit from the details and just ask ourselves, well, from a social perspective, what does society want from a stock market? What does a stock market accomplish for a society? There's really three main things that stock markets accomplish. First of all, they allocate capital. It's a place for companies to raise money to take investments. Second, they provide liquidity so that people who buy into those investments don't have to necessarily remain invested as long as the company remains invested, that an individual can get back out and transfer the position to somebody else. The third thing is they discover prices. Markets discover prices. Now, we go back to our economics course. Price is determined by supply and demand. There's a so-called Walrasian auctioneer who observes the supply curve, observes the demand curve, and decides what price clears the market. You know, that's all good as an abstraction, but that Walrasian auctioneer who looks at the supply and demand curves to figure out the equilibrium price, that guy doesn't exist. So there needs to be a mechanism for figuring out what is the fair price. And so we refer to that as price discovery. So what do we want as a society from the markets? Allocate capital, provide liquidity, and price securities efficiently. High-speed trading, if they're providing liquidity and if they're doing arbitrage trades, should be contributing to the second and third functions that we want a stock market to accomplish for us. I'll also mention that when you do have fragmented markets, and I understand this is not so much of an issue here in Thailand, but in many markets around the world, there's now trading of given stocks in more than one market. Some people worry about fragmentation of trading. How do we know we're going to get the best price when my order gets routed to one market, but there's several other markets? How do I know there wasn't a better price in the other market? Well, high-frequency trading may well have, by arbitraging price differences across markets, may well have the effect of turning several fragmented markets into a single virtual market. Now, front-running or predatory trading, on the other hand, it's less obvious that that's a good thing for the markets or for society as a whole. Although it's also not quite as obvious that it's bad as it might seem to be. And I have a paper that I'll mention just briefly later. But anyway, it's not obvious that's good. We have that much at least, that it's not clear that this is an activity you want. The observation I'd make, though, about potentially trying to restrict front-running or predatory strategies is it's really hard to know how you word the regulation to restrict front-running strategies without also restricting arbitrage. I mean, what's an active profit-motivated trader trying to do? They're trying to find securities to buy ahead of price increases, and they're trying to find securities to sell ahead of price declines. And if it's based on some fundamentals, we might call it arbitrage and say that's good. It's making price discovery work better. If it's based on forecasting somebody else's orders, maybe it's not so good. But exactly how do you write a statute that says it's okay to trade based on fundamentals but not based on your perception that somebody else is going to trade? So this is I think, a really tricky thing to think about regulating. The last point I'll make is that manipulation, if some high-frequency traders are following manipulation strategies, in most markets, manipulation is already illegal. And it's not clear to me that you need separate regulation of manipulation by high-frequency traders as opposed to anybody else who might be trying to manipulate the market, say by spreading false rumors or whatever other methods there are of manipulating. Regulators are under some, I don't know if pressure is the right word. Regulators are considering regulatory responses and restrictions. It'd be hard not to, given the negative publicity about high-frequency trading. So the sort of regulatory responses that are being discussed and in some cases already implemented, things like a minimum quote life. Okay, if you're going to put in a limit order, you have to leave it there for some amount of time, like 50,000th of a second, for example. Quote cancellation fees. Okay, so you put in a limit order. If it leads to a trade, that's all good. But if you want to cancel that limit order without having a trade executed against it, it'll cost you something. You'll pay a fee. Or transaction taxes. That one's popping up in the discussion pretty often these days. Maybe because governments want more revenue too, and they see all this trading going on, and they say, you know, if we just got a really small slice of all that trading. My main observation about regulatory solutions of these types is that they're blunt. They affect all high-frequency traders. And I'm going to talk more in a moment about the evidence, about the systematic evidence as opposed to the stories told by individuals to reporters. I'll talk more about the evidence, but to the extent that high-frequency traders are doing some things we want them to do, like provide liquidity and improve price discovery, a regulatory response that affects all high-frequency traders is a pretty blunt instrument. Well, the alternative, of course, is not to take responses that affect everybody, but to take responses that are targeted at particular types of strategies that we're less convinced are desirable. Kind of touched on this already. So the regulatory responses that are being considered, the question I would pose is, are they really based on careful, systematic evidence about what high-frequency traders do? Or are they based more on anecdotes and assertions of what they might? It'll cost you something. You'll pay a fee. Or transaction taxes. That one's popping up in the discussion pretty often these days. Maybe because governments want more revenue too, and they see all this trading going on, and they say, you know, if we just got a really small slice of all that trading. My main observation about regulatory solutions of these types is that they're blunt. They affect all high-frequency traders. And I'm going to talk more in a moment about the evidence, about the systematic evidence as opposed to the stories told by individuals to reporters. I'll talk more about the evidence, but to the extent that high-frequency traders are doing some things we want them to do, like provide liquidity and improve price discovery, a regulatory response that affects all high-frequency traders is a pretty blunt instrument. Well, the alternative, of course, is not to take responses that affect everybody, but to take responses that are targeted at particular types of strategies that we're less convinced are desirable. Kind of touched on this already. So the regulatory responses that are being considered, the question I would pose is, are they really based on careful, systematic evidence about what high-frequency traders do, or are they based more on anecdotes and assertions of what they might be doing? So what I want to do with remaining time is try to survey the scientific evidence, the evidence that's being produced by people like me, not me. I haven't personally studied high-frequency trading, but the evidence that's being produced by people who are trained to evaluate the data and have no particular vested interest on one side or the other of the debate. So I'm going to survey several of, or summarize several of the papers that are out there. They're all quite recent because the phenomenon is recent, and it's only recently that we've been able to come up with data to systematically study these issues. The first of the papers that showed up is now all of 2 years old, by a fellow named Jonathan Brogard. So his paper's titled "High Frequency Trading and Its Impact on Market Quality." So I'm going to mention a number of papers here. If you're interested in seeing the papers, Google search should bring them up. If you have any trouble finding any of them, just email me. My name comes up really easily in a Google search because there's just not that many Bessembinders doing finance research out there. In any event, you can probably find these papers with a Google search, and if not, get in touch with me. So Brogard's paper, "High Frequency Trading and Its Impact on Market Quality." So the markets themselves, of course, are very interested in knowing the answer to what's the effect of high-frequency trading on the quality of our market, and the markets are facilitating study in several cases. So the NASDAQ market in the US was the first. So the NASDAQ market went into their own trading records, and of course they know who's trading. We outside researchers tend not to know who was involved in an individual trade, but NASDAQ knows who was trading. They went through and they basically identified a set of firms that were following what seemed to be high-frequency trading strategies. And then they flagged those trades in the data and provided the data to a number of researchers. So it's quite a nice database. It's also something that's useful about the data is any given trade in a limit order market, you could say one side of the trade demanded liquidity, that it was the marketable order, while the other side was providing liquidity. It was a non-marketable order that was sitting on the book until the liquidity demanding order hit it. So it also indicated which side of the trade demanded liquidity and which side of the trade supplied liquidity, which is useful. So it's quite a nice database. The only real disadvantage is that NASDAQ provided the data, but they only have this data for the trades that are done on the NASDAQ market. And as I mentioned a minute ago, these days trading is fragmented. So these same stocks are also being traded on other markets. So it's not all trading in these stocks. It's a slice, but still it's useful for study. The first thing I wanted to show you is just this red graph here, and I don't know if you can make out all the details, but here's the punchline. The red graph is the percentage of all the trading on NASDAQ that the high-frequency firms were involved in. And as you see, it's between 60 and 70%. It's big. High-frequency traders are not minor players in the modern stock markets. The bulk of the trading involves high-frequency firms on at least one side of the trade. Some of the other conclusions that Jonathan Brogard came up with in this first scientific study of what high-frequency traders do is they provide a lot of liquidity. So the best quotes, the best unexecuted limit orders, which comprise the bid-ask spread in these markets. High-frequency traders are participating in the bid-ask spread 65% of the time. 2/3 of the liquidity provision at the bid-ask spread is coming from high-frequency trading firms. High-frequency trading firms provide about 25% of the depth in the limit order book in total. So that includes orders that are outside of the best quotes. They're providing about a quarter of the liquidity in the limit order book. They're contrarian. Contrarian in the sense that if there's recently been more buyer-initiated trades, the high-frequency traders tend to sell, and vice versa. For those that are worried about high-frequency traders destabilizing markets, this evidence goes the other direction. Contrarian trading tends to stabilize markets. Their profit averages about 3/4 of a basis point relative to the amount traded. The basis point, of course, is 1/100 of 1%. So I guess it's subjective whether that's a big number or a small number. What I can say is that it's a small number relative to the bid-ask spreads we used to see in these markets 10 or 15 years ago. So they are making money, but about 3/4 of a basis point of the amount they trade. I've got a couple of slides here about the competitive effects of high-frequency traders when they arrive in a market. So the first of them is a paper by Janovich and Menkveld, came out last year. It's titled Middlemen in Limit Order Markets. So they have a model, first, a theory section in their paper, and they do make a conceptual point that's worth thinking about. So people who study markets have had models of liquidity provision, models of market making for some time. One of the costs of being in the business of providing liquidity to the markets is that there might be somebody out there who knows something you don't. Adverse selection, we call it, or the winner's curse, or the lemons problem. If there are people out there that know more than you, when they trade against you, it's bad news. How do you protect yourself against that? Well, as soon as you get any inkling that things have changed, you'd like to update your quotes. Right, so one of the points they make is that if you can update your quotes more frequently, you're more willing to provide liquidity. Of course, the essence of high-frequency trading is you can update your quotes frequently, and they do update their quotes frequently. So anyway, they have the theoretical prediction that it should be possible to provide liquidity more effectively if you can update your quotes more quickly. Then they have the part of the paper where they actually study data. So the event they study the Dutch and German stock markets, and in particular the introduction of a competitor, Chi-X, an electronic competitor, to the main market, which was Euronext. And they point out that Chi-X was designed to be high-frequency trader friendly relative to Euronext. So they didn't charge for order cancellations. They provided make rebates. I guess many of you will be familiar with the notion of make-take fees, where you pay a fee if you send in a marketable order. But if you put in a non-marketable order, provide liquidity to the rest of the world, somebody else hits your order, you get a rebate. So they instituted rebates if you provided liquidity to the market. And they also had faster computer systems. So introduction of a new competitor that's high-frequency trader friendly. Bid-ask spreads decreased 20% when Chi-X and its high-frequency traders entered that market. Another paper about competition from high-frequency traders. You'll recognize the name Menkveld, one of the authors on the previous paper. This is a more detailed case study. So he looks at the Amsterdam market in particular, and he's able to obtain specific trading records for one individual high-frequency trader. So this high-frequency trader entered trading for Amsterdam-listed stocks shortly after Chi-X entered, and basically gave them the venue, the avenue for that. This high-frequency trader is very active, 1,400 trades per stock per day. So this single high-frequency trader is doing about 14% of the trading activity in the market. That's a big player. High-frequency trader provides liquidity. That is, somebody else is hitting their standing limit orders as opposed to they're hitting somebody else's standing limit order. They provide liquidity on 80% of their trades. They earn about 0.88 euros per trade. The breakdown of that was kind of interesting. They earn about 1.5 euros from capturing the bid-ask spread, but then they give back 2/3 of a euro on average. This is all averaged across hundreds of thousands or millions of trades. They give back about 2/3 of a euro based on adverse price movements after the trade. The reason that's significant, it suggests that in this case at least, the high-frequency trader is not the person who knows something the rest of the world doesn't know. In fact, it's the other way around, that the people who are trading against the high-frequency trader on average are the ones who know something. The price movement is in favor of the person that just made the trade and against the high-frequency trader. But here's the most striking thing. Here's the most striking thing out of the paper. Bid-ask spreads decreased by 50% after this single large high-frequency trader entered the market. A fellow named Al Carrion has a paper, current paper, titled Very Fast Money, High-Frequency Trading on the NASDAQ. I know Al pretty well. He was a Ph.D. student at the University of Utah, so this is his dissertation. I supervised the work, but it is his work. He gets the credit for it. So he studies the same NASDAQ database as Brogard, who I referenced a few slides back. So he documents some interesting things about the high-frequency trading on the NASDAQ. So first of all, the high-frequency traders on NASDAQ, sometimes they demand liquidity, sometimes they supply liquidity. But it's not random. They supply liquidity when the bid-ask spreads are wider. They demand liquidity when the bid-ask spreads are narrower. Kind of makes sense. They supply liquidity when it's more profitable to supply liquidity. They use the markets to accomplish the trades they want to get done themselves, whether that's inventory balancing or something else, at times when it's cheaper, when the spreads are narrower. Maybe the most interesting and important result in the paper is this one. He looks at the speed with which prices incorporate information. When new information comes into the market, how quickly do the prices reflect that information? He finds they reflect the information more quickly on days and for stocks where the high-frequency traders are more active. And it's their liquidity demanding trades that lead to that more rapid incorporation of information into prices. So the previous 2 or 3 slides emphasized the liquidity provision by high-frequency traders. Here, there's evidence, well, sometimes they provide liquidity, sometimes they trade actively, but when they're trading actively, they're leading to prices incorporating information more quickly. But not all high-frequency trading firms have to be alike. There's a lot of firms doing high-frequency trading strategies, and there's no guarantee that they're all using the same strategies. The debate sometimes seems to consider them to be just a block. High-frequency traders do this. You see that sometimes in other controversial areas like, say, short selling, which is also controversial. You hear people saying, well, short sellers are this, or short sellers do this. You know, this is a technique. And there's a bunch of different firms, a bunch of different individuals. There's no guarantee they're all doing the same thing, and there's no real reason to think they're all doing the same thing. So, an interesting paper on this topic. Again, a recent paper, Hagströmer and Norden, the diversity of high-frequency traders. So, I mentioned the exchanges themselves are cooperating in the study of high-frequency traders because the exchanges too want to know. What are the high-frequency traders doing, and what's the impact? The NASDAQ OMX, so that was from a merger of NASDAQ with the OMX exchange. But this is the Stockholm stock market. The Stockholm stock market is making quite a bit of data available, including trader identities. not names like the name of the bank, but an identity like Trader 47, so that the researchers can basically track an individual trading account, an individual trader through time and see what they do. The other thing is that if the order is entered by a computer algorithm, the exchange flags that separately from an order that's entered with human involvement. So it's a very nice database for actually studying what individual firms that use algorithms are doing. So a number of findings in the paper. First one, high-frequency trading firms supply liquidity more often than they demand liquidity. So again, they are supplying liquidity to the markets on balance. Most of the high-frequency trading activity, 70 to 80% of it, is associated with market making, with providing liquidity to the markets. But not everybody. So the rest of it they just label as opportunistic high-frequency trading, something besides providing liquidity. Although on this assertion that high-frequency traders are entering too many orders, quote stuffing is the phrase that's sometimes used, they actually find that the market-making high-frequency traders have higher order-to-trade ratios than the other high-frequency trading firms. I think that's kind of interesting. It's suggestive that this high order-to-trade ratio is something that comes from the business of liquidity provision in today's computerized markets. And I think it makes some sense. You want to be able to rapidly update your quotes as market conditions change in today's rapidly moving markets. This last point I think is kind of interesting for policy. So the tick size, is an interesting characteristic of financial markets. The tick size, of course, is the smallest minimum price increment. And one of the features of the tick size is that your bid-ask spread never gets smaller than your tick size. On the Stockholm, as well as several other markets around the world, the tick size depends on the price of the stock. And so at higher price levels, there'll be higher tick size. So let's just say that the break point is 10 euros. If the stock is trading just below 10 euros, it has one tick size. Then if it trades just above 10 euros, it's got another tick size. So if you study a market like that, you actually get a lot of events where the tick size changes as the stock price passes through one of these thresholds. So they take advantage of that to see what's the effect of a changing tick size on high-frequency trading activity. What they found is that with a bigger tick size, you got more market-making activity and less opportunistic activity by high-frequency traders. I think that actually makes sense. Why a bigger tick size basically means a wider bid-ask spread and more profitable to be a liquidity provider. And for the same reasons, it makes it more costly to be a liquidity demander. But anyway, I think that's an interesting observation for those who are charged with potentially regulating high-frequency trading. The tick size seems to matter for what high-frequency traders do. Now, this question of potential front-running or predatory trading definitely cannot be ruled out of hand. We need systematic evidence. There's a fellow named Mark Hershey who wrote a paper that came out last year. Do high-frequency traders anticipate buying and selling pressure? So he's back in this NASDAQ data set that Brogard and Carrion were in. He documents a number of interesting findings. First of all, he finds that aggressive, that is the liquidity demanding buys by high-frequency traders precede price increases, and sales precede price declines. In other words, they seem to be anticipating where the price is going to go. Now, he takes it a step further. Aggressive, that is liquidity demanding high-frequency buy trades precede aggressive buy trades by other non-high-frequency traders. That's consistent with order anticipation or front-running. They also show that if you're a high-frequency trading firm who is good at anticipating others' orders this month, you're probably good again next month. In other words, there's evidence, some skill at this business of forecasting other people's orders. It's not just somebody's randomly good this month, but not the next month. So he fairly aggressively interprets the evidence as being consistent with the predatory trading or anticipatory trading story. We want to keep in mind here the high-frequency firms are working off of information that's publicly available. It's not an assertion of insider trading or trading on non-public information. So in that sense, it's generally not illegal, at least in the markets that I'm familiar with. It's not illegal to figure out that somebody else is going to trade and trade in front of them. Of course, that could change tomorrow, right? In any case, whether it's legal or not, it raises the question, is it fair? And we would ask ourselves also, does it potentially degrade market quality to have people using order anticipation strategies? But just in the argument of, in the interest of completeness, I just mentioned that it's also, so the evidence is consistent with the high-frequency traders are using order anticipation strategies, but the evidence is also consistent with the idea that the high-frequency traders are simply detecting something fundamental and reacting more quickly than the non-high-frequency traders. That would also lead them to have their trades completed, be in the same direction and completed ahead of the non-high-frequency traders. Again, the fairness argument would come up. You know, is it fair that the high-frequency trader was able to react more quickly than me? But that's a subjective question. For those of you who are interested in algorithmic trading more generally, if it is true that the high-frequency traders engage in order anticipation strategies, you want to take that into account. So if you're, for example, if you're over on the brokerage side and you're designing an algorithm to feed your clients' orders to the market, and there's high-frequency traders out there trying to anticipate your orders, you want to take that into account. Interestingly enough, there's two possible ways to handle this. The first one, I think, kind of obvious. Don't be predictable. Randomize. You know, randomize the times you submit the orders, randomize the quantities that you put in, randomize the time till cancellation of your orders. Just don't be predictable so they can't predict your orders. Maybe more surprising is that there's another possible strategy. Be completely predictable. Now, why might a strategy of be completely predictable make any sense? What if there's lots of potential predators? What happens if the predators are competing with each other for the right to trade ahead of you? They also want to trade ahead of the other predator. So an interesting case study in this is energy ETFs, exchange-traded funds. So exchange-traded funds, there's several exchange-traded funds that what they promise their investors is returns that mimic commodity prices. And how do they actually do that? Well, some of them, like say a gold ETF, might actually hold gold. Gold has a pretty low storage cost relative to its value. But a lot of the other ones, it's too costly to hold the physical commodity, so they take positions in the futures markets, which is all good. The only thing is individual futures contracts expire. And you know, the crude oil ETF doesn't really want a tanker of crude oil coming in. They've got no place to store it. So they sell off the maturing contract and buy a more distant maturity contract. And they do that each time one of the contracts matures. But they're big and now they're predictable. Their response, the energy ETFs, their response is to be as predictable as possible. They actually put it on their website. We are going to roll our positions. We're going to sell our positions in the expiring crude oil contract and buy the second contract, and here's the quantity, and here's the day we're going to do it. And they basically say, you want to predate us? Everybody come and compete with each other for the right to be the predator. And I've actually got a working paper. I don't have time to go into it in detail, but we study what actually happens here when somebody's completely predictable, and they actually get really nice executions on their trades. So getting the high-frequency traders to compete with each other to be in front of you can be a viable strategy. The quote traffic question. So there's a paper that just came out recently by Guy, Yao, and Yi, The Externalities of High-Frequency Trading. So it had been previously noted that there's a correlation between quote traffic and stock price volatility. So that times when stocks are more volatile are times when there's more quote traffic. But correlation doesn't necessarily mean causation, right? Causation could be going either way. We could have more quote traffic because conditions are more volatile, or all this quote traffic might be causing the volatility. You just can't tell what the direction of quotation is from the fact that they're correlated. They looked at an interesting event during spring of 2000. NASDAQ upgraded their technology that basically allowed them to process quote traffic more quickly. Now, I'm not a computer scientist and I can't explain the details to you, but the minimum time between messages was reduced from 950 to 200 nanoseconds. Nanoseconds is billionth of a second. So I'm not a computer scientist, but that sounds really fast to me. All right, so they changed the technology so that they could move message traffic substantially more quickly. So these three researchers studied NASDAQ. NASDAQ, again, cooperated, made the data available to them, studied quote traffic. Some interesting findings. The first thing, canceled quotes. Canceled quotes are the main thing that's chewing up computing resources for the exchange. They document 97% of the message traffic is related to quotes that are entered and canceled without executing. When the technology changed to allow yet faster quote traffic, this issue became sharper. The order-to-trade ratio, number of orders entered relative to trades completed, rose from 26 to 32. So the high-frequency traders responded by putting yet a larger volume of quote traffic in. They didn't really see any change in bid-ask spreads around this. The last point is really their most damaging evidence. So just a little bit of background here. So NASDAQ, I'm not sure you can make that out. NASDAQ has 6 channels. 6 channels where they route their message traffic. And stocks are assigned randomly across the 6 channels. So there's no particular reason to think that economic fundamentals should be correlated more within a channel than across channels, because the assignment of stocks to message channels is random. But these researchers document that the correlation in quote traffic within a channel rose after the technological change. And I think they're being a little aggressive in their interpretation, but I'd agree at least the results are consistent with their interpretation. They believe the high-frequency traders are deliberately increasing quote traffic to slow down the system. So that is, they interpret the evidence as consistent with a quote stuffing strategy. The other question, how am I doing on time? When should I plan to wrap up? 5 minutes? Okay, good. Aim for 5 minutes. The other question is, do they disappear? Do they disappear when we need them most? So probably the biggest and most widely publicized case study on this question is the flash crash from the US 2 years ago. So I imagine most of you have heard of this incident, but what happened is that stock prices fell about 6 to 8% in just a few minutes, and then recovered. what happened? Did the high-frequency traders cause it? Did they make it worse? Some individual stocks gyrated a lot more. The overall index dropped 6 or 8% for a few minutes and then popped back up. Some stocks dropped a lot more. The press reported that some of the high-frequency trading firms, when this started, just unplugged and went home, unplugged and waited. So liquidity became scarce and expensive during this period. I just want to point out that something becoming scarce and expensive is not necessarily a market failure. I mean, if there was a crude oil disruption in the Persian Gulf tomorrow, gasoline prices would jump. As buyers of gasoline, we wouldn't like that, but that doesn't necessarily mean it's inefficient from an economic viewpoint or that it's a market failure. When things get scarce and expensive, prices go up. The best study to date of what happened in the flash crash is by Kirilenko, Kyle, Samiti, and Tuzan. It's at least semi-official report, and that some of these people worked for the Commodity Futures Trading Commission and the Securities and Exchange Commission at the time. So they got data from the Chicago Mercantile Exchange S&P 500 E-mini contract. Now, why that contract? It's an equity index contract, and previous research has shown that this is basically a leader for the rest of the markets. The electronic stock index contract is the one where people who know something go to it first, and it's a bellwether contract is a phrase you hear sometimes. Other parties look to that contract to see what's going on. So they studied that contract. They had the individual accounts. They can track the activity, and in particular, they can pick out high-frequency traders. So the initial reports were saying high-frequency traders triggered this crash. They didn't. It was just a clumsy big trade by an old-fashioned buy-side manager, a mutual fund firm. But apparently, they magnified the crash because as the market started to drop, the high-frequency traders stopped supplying liquidity and started demanding liquidity to get out themselves. And since we're nearly out of time, I'm going to skip through some of these materials. I just want to mention one thing really quickly, though, in passing. So opportunistic traders in this study, these are not the high-frequency traders. These are some other traders. Just want to mention what happened with these so-called opportunistic traders on May 6th, which was the day of the flash crash. So the blue line is the prices during that day. There's the 6% drop and then the recovery. The red line is the positions of these opportunistic traders. Notice the price dips, position of the opportunistic traders jumps. These are the people who were smart enough to buy when the price was dipping. The next line, profits and losses of opportunistic traders. The red line is their cumulative profits for the day, close to $100 million. So the high-frequency traders bailed out of the market, handed someone else $100 million. High-frequency traders learn from their mistakes as well. It's not so clear to me that the high-frequency traders would panic again next time and let somebody else walk away with the $100 million. Okay, I think I'm almost out of time. I had more that I could have potentially said here, but I think in the interest of time, I'll jump ahead to my conclusions. So high-frequency traders are frequently vilified. Blunt regulations being considered, but the criticism is sometimes at least originates with competitors that are having problems competing with the high-frequency traders, and the criticism is oftentimes based on anecdotes. Somebody said, this is what I saw, as opposed to a careful assessment of the data by researchers without a vested interest. The systematic evidence that's available to date provides a lot of evidence that high-frequency traders as a group provide liquidity, narrow bid-ask spreads, and improve price discovery. Blunt responses, like a transaction tax, would get in the way of this type of high-frequency trading as well. But not every high-frequency trader is alike, and there is some evidence that suggests that at least some of the high-frequency traders might be following predatory strategies. It's possible that they're following manipulative strategies. There may even be some of this quote stuffing going on at times, putting extra message traffic in to slow down the network for others. But my thought about those types of activities is, if we decide we don't want this happening, if we decide we don't want order anticipation strategies, regulations can be tailored to focus on those strategies in particular, as opposed to something like a transaction tax that would affect all high-frequency trading, rather than just the conduct that we're concerned about. And the last part I kind of had to skip over a little bit, but there is reason to think that high-frequency traders will cut back on liquidity provision during the scary times in the markets, like the flash crash. And I actually have a theory paper that I didn't get a chance to deal with, but in our theory paper we argue that in fact it may well make sense to write contracts with high-frequency traders that require them to stay in the market during tough times, to avoid their pulling out of the market just when we need them most. But if it is a competitive market otherwise for liquidity provision, you can't just say you must do this and you must take losses at times like that while having a competitive outcome the rest of the time. That would be counterproductive. You'll scare the people out of the market. So we actually propose contracts where you compensate high-frequency trading firms in exchange for their promise to remain in the market during times of turbulence. So I'll close it there.
I would like to thank Professor Hank Bessembinder very much. And at this point, I would like to invite all the speakers from today to be on the stage and take pictures with Professor Bessembinder. First, Dr. Pakorn Pitawachai from Stock Exchange of Thailand. Also, Associate Professor Dr. Santi Thirapat from Chulalongkorn University, and Dr. John Wongsawan from Patara Securities. You are invited on the stage.